The stock market has been absolutely hemorrhaging losses, and I think it's very important that we all figure out what our recession game plan is. And that's what we're gonna cover in this video. So smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up, guys? Welcome back to the channel, where the goal here is to help at least 1,000 people achieve financial independence much sooner. And you guys already know the stock market has been almost in a free fall, and pessimism is all over the place as people expect more and more rate increases by the Fed. The thing I wanted to point out is that during market run-ups, channels like mine are pretty uninteresting. You guys knew that back in 2021, I didn't really point out a lot of securities because there really wasn't a lot of opportunity in the market. Meanwhile, there were other channels on YouTube where every day they were just like, hey, buy this stock, buy that stock, blah, blah, blah. All of those stocks are down now. And the reason for that is because people don't really focus on fundamentals when everything's rushing up at the same time. In fact, it's almost hard to focus on the fundamentals. You're almost just the weird guy in the corner of the room at a party when you're focusing on value type principles and fundamentals of what you should be paying for a security. However, in environments like this is where it becomes important to always focus on the downside. And so I think this channel becomes way more important as the market goes down. And I got inspired to make this video because I was at dinner with a friend of mine who's known me for over 20 years. And he said, hey, every time the market goes down, you've always been like this. You always get super excited. You never want to hang out with us because you're too busy doing your investment work. But that's the whole thing. When the markets decline, when things go on sale, that's when we as value investors should get excited. And I haven't been this excited in a long time. In fact, it's probably the most fun you can have with your clothes on. Okay, let's get right into it. So you can see here, the S&P 500, at the time of the recording of this video, notice that the S&P 500 is down almost 19%. And just putting it into context here, since around 2017, the S&P is up 62%. And you can see that since that decline in 2020, the stock market really ran up way past that 3,500 point mark. And we kind of have to be honest, part of that was really excess. And it was because there was such low interest rates and a lot of money being pumped into the market. Of course, it took up the securities market. A lot of people took money that they did get from the government relief and put it right into the market as well. And so that really pumped up securities, and we saw some crazy stuff happening. People are pumping all sorts of names that should have never reached the valuations that they did. Like, for example, Rocket Mortgage went up simply because the name had the word rocket in it. That was crazy. And we can see here that the Vanguard Information Technology Index Fund ETF, it's actually down more than the market as a whole. And the reason, of course, as you guys know, is that information technology stocks are the ones that led the rush upwards back before this recent decline. And of course, one of the reasons why a lot of people are pessimistic right now is because the Federal Reserve's policy is to continue increasing rates, which increases the risk of a potential recession. Of course, they're looking for a soft landing, so that's what they're going to try and do, but we'll see how this plays out. But you'll see I put a note here that a majority of poll respondents now expect the Fed funds rate to be at 2.5 to 2.75 or higher by the end of 2022. That's more than double from the 0.75 to 1% as it stands today. So that could really take stocks down further than they already have. But the one thing that I did want to point out for you guys is look where the rates are. This is just a view of the interest rates from back, I guess, to 1970. You can see here that the rates are still near historic lows. And the central bank added that ongoing increases in the target rate will be appropriate, with Chair Powell pointing to 50 basis point hikes in the next couple of meetings. So expect greater and greater amounts of increases going forward. And you can see back in around 2016, when they did start raising rates, the reason why they did say that they were going to be raising rates back then, even when the economy was a bit stronger, was one of the reasons is they wanted to make sure that they have the ability to reduce rates if a shock in the economy came. So one of the things that's probably stressing them right now is, one, obviously inflation is running really hot and they want to tame that. But the other thing is they're running out of tools to address subsequent crashes to the economy. So you do want rates to be a little bit higher so that they have the ability to bring them back down should they need to. But guys, remember what happened when they did start raising rates back in 2016. What we had was a bit of a tantrum with the market. The economy actually started going backwards, and so they actually were forced to reduce rates right before the COVID pandemic. And then, of course, when COVID happened, they just bottomed those rates completely. So obviously you can see they have start raising them at the end here, and they'll probably continue to raise them back. I just don't think they get to the 2.5%. I just don't see it happen. But putting this into a greater perspective, you guys can see this is back from 1990. So we went through the dot-com bust. We also went through the subprime mortgage crisis. Both of those were really tough to deal with. Although I did go through the dot-com bust, I didn't really have a significant amount of money on the line until we went through the subprime crisis. But here's one thing I want to point out to you, and I have it highlighted here. The first circle on the far left here, you'll notice that I've made a circle, and then all the way down to the bottom of the downturn for the subprime mortgage crisis, I made another circle. And the reason why I did that is because when the subprime mortgage crisis was happening, the thought that most people had were, this is it. The economy is falling. The sky is falling. We were at 10 or 15% unemployment. Everybody was getting out of the stock market. People were staying in cash. There was peak fear, way greater fear than what we're experiencing today. However, there was a very famous investor, and he started buying at that circle point there. In fact, he was probably buying before then, but he put out an article in the newspaper where he started to say that the time to buy America is now. Don't wait until things turn around. And some of you guys know who I'm talking about, and you guys have probably even read in real time what that very famous article was. And so you can see it here. I actually have this on my wall. Here's a very important point from that article. It says, "Let me be clear on one point. I can't predict the short-term movements of the stock market. I haven't the faintest idea as to whether stocks will be higher or lower a month or a year from now. What's likely, however, is that the market will move higher, perhaps substantially so, well before either sentiment or the economy turns up. So if you wait for the robins, spring will be over." In other words, you are not going to be able to time a downturn. I was not able to time the downturn back in 2020. I started buying as soon as the market started declining when I saw valuations get to a point where it was very exciting to buy them. And so who's the guy who wrote this article? Well, you guys know him. His name's Warren Buffett. And the article is called Buy American, I Am. And you can notice it was released on October 16th, 2008. So he missed the bottom himself. So if the greatest investor of all time missed the bottom during one of the worst downturns ever, what chance do you have of catching the bottom? And so the way I go about this is I systematically allocate funds, and as securities of really good companies get under 50% of their valuations, I start really thinking about buying them. Sometimes I'll sell cash secured puts. Sometimes I'll buy them flat out, but I'm always engaging in this market, and I always have more and more cash coming in so I can continue buying them. It's just part of that program, right? Dollar cost average as much as you can, and don't worry about the market continuing to go further and further lower. It doesn't matter, because the price at which you buy the securities, that's already a very good price because you've done your research already. Now, there's another very important quote from the book Intelligent Investor. And if you haven't read Intelligent Investor by Benjamin Graham, I highly encourage you to get your hands on it and read it. But here's the quote. So it says, "The most realistic distinction between the investor and the speculator is found in their attitude towards stock market movements. The speculator's primary interest lies in anticipating and profiting from market fluctuations. The investor's primary interest lies in acquiring and holding suitable securities at suitable prices." So, in other words, when we buy securities, the idea is to hold these securities over the long term. If I'm buying a company at, say, 5 times earnings, yeah, those earnings might drop in the near term. However, over the long term, chances are I bought a company at 5 or 6 times earnings. And so that income yield that I'll be generating for the perpetuity of that investment will be substantial. And that'll allow me to redeploy capital into subsequent investments. And so going on, he says, market movements are important to him in a practical sense because they alternately create low price levels at which he or she would be wise to buy. So in other words, the old adage of when the prices are high, don't buy, which is exactly what we did in 2021. And now as the prices are getting low, it's really important to start considering if any of your favorite securities of really strong companies that will live another day are cheap enough to buy. And then he finishes here, the investor with a portfolio of sound stocks should expect the prices to fluctuate and should neither be concerned by sizable declines nor become excited by sizable advances. Because at the end of the day, it doesn't matter. You're buying an income stream of a productive asset. It doesn't matter if after you purchased it, the price continues to go down or it rockets up considerably. I mean, it could matter that if the price continues to go down and you love the company, you'll buy more of it. And it could matter that if the price is exceptionally high to the point where you're getting like 15 or 20 years worth of income just from selling that investment, it might make sense. But for the most part, it shouldn't matter to you. And truthfully, it really never does matter to me. And Benjamin Graham finishes by saying he should never buy a stock because it's gone up or sell one because it's gone down. Never buy a stock immediately after a substantial rise or sell one immediately after a substantial drop. And that's probably a really good rule that we should live by. Never make an investment decision to buy a security after a huge increase, and never make a decision to sell a security after a huge decline. Always remember, why did you buy that security in the first place? And did you purchase it for a substantial discount to its intrinsic value at the time that you bought it? Because then if it got cut by 50% and that intrinsic value still remains, then it's worth it to buy more. Now, can the intrinsic value change? Absolutely it can, but these are risks that you have to identify from the onset to make sure that you minimize as much opportunity for that intrinsic value to turn downwards as you can. Now, it's very difficult to price securities every day and determine whether they're trading above or below their intrinsic value. I think the easiest way to handle this is by having a stock tracker. And so that's what we do with the Patreons at that $5 level. You can see here that currently there's 6 names in the tracker that are trading under 50% of their intrinsic value. And this tracker updates every day as the prices of the companies update. There's a record number of companies approaching 50% of their intrinsic value. And so that's really exciting because I'm actually excited to add more and more of these names. I actually believe in diversification. I know Charlie Munger doesn't agree with me here, but we can respectfully agree to disagree here. I want more names in my portfolio. I would like to have at least 10 or 15. And the other point is that not any company makes it onto the tracker list. It has to be a company that I'm excited to follow. And so greater than 50% of the companies that are on the tracker have no debt, which is perfect for a rising interest rate environment. There's a lot of zombie companies out there and there's a lot of money that's been invested into these zombie companies. And so there's gonna be a lot of disappointed investors when these companies cannot service their debt. Now, if you've been following this channel for a long time, you know all of the stuff that I just told you. So I don't wanna leave you with that. It's my birthday after all, so I wanna give you guys a really cool present. So you can see here that I have market crash rules. Market crashes are wonderful opportunities to purchase great companies at bargain prices, but there's 4 important rules that you have to pay attention to. So what are those rules? Well, these aren't my rules. These are Warren Buffett's rules. So the first rule is the business model simple and easy to understand? If it's not, you shouldn't be buying the company. And there's going to be different business models that are going to be easy to understand for different people, depending on your area of expertise or what we like to call your circle of competence. It's okay to say, hey, I don't understand this that well. Move on. The second rule is, does a business have favorable long-term economics? How can you pay a perpetuity value for the business if you can't determine if it's going to stick around for the long term? So this is a very important point that a lot of investors miss, especially during times of euphoria like we just went through. The third rule is it run by competent and willing shareholder-focused management? And so the one thing that we track on the tracker is what percentage of the free cash flow is share-based compensation. If you're looking at share-based compensation being greater than half of the free cash flow and the company is relatively mature, is that really a shareholder-focused management? So that is something that I would encourage you to look at. There's other things too, right? Are they investing in areas that are outside their own areas of expertise, right? So things to think about when even assessing the management strategy. And so I would say this is a soft area and everyone's gonna have different conclusions about management. However, it's important to take a stand for yourself as to whether or not you believe that management are focused on your best interest as a shareholder. And then the fourth rule is make sure that you're buying the stock at a price that reflects a considerable margin of safety. And my personal preference is less than 50% of its intrinsic value. Not everybody agrees with that, but in environments like today, it's really great that I've been remaining patient. And the other point that I wanted to show you, and this is the most important point of this whole video, is that if you save $2,000 a month at an 8% annual return, notice that we are playing the game on the left side of this graph the people in the news and the portfolio managers and all of those people, they're playing a game on the right side of the graph. And so the most important takeaway from this graph is that the return from interest or earnings does not become more important than the amount that you save until year 10. So you can notice here in year 1, the greatest jump in your portfolio, 96% of the jump in your portfolio is going to be just from how much you deposit into it. And then at year 8, still 56% of the increase in your portfolio is going to come from the income or savings that you deposit into the portfolio. So don't play the game of the portfolio managers where you're focusing on returns. Focus on your personal financial situation and how much you can save and stick to your plan. During downturns, it's a great time to dollar cost average. So if you can take a screenshot of that chart, take a screenshot, put it up on your wall. That's the most important chart when it comes to getting rich. The focus is, especially in the first 10 years, where a lot of you guys are in your first 10 years, focus on how much you can put into the portfolio. And if you want access to our Patreon models, you can get access to the tracker, and every single name in that tracker, you can click into a fully built out model for each of those companies. You can access that at the $5 a month Patreon tier. And like I said, if you decide that it's not for you, you can get 100% refund in the first month. In fact, Patreon doesn't even charge you until the end of the first month. But the cool thing is the Patreon actually has a greater than 100% retention rate, which means that more people upgrade than leave at the end of the month, which is great news for me because it shows that it's really providing value. And at the end of the day, all I'm trying to do, the whole reason why I started this YouTube channel is not really to make money. It's to help at least 1,000 people achieve financial independence much sooner. That's why I say it at the beginning of every video. And so the legacy of this channel will be that by the time it's done, I will have helped a ton of you. Now, the other thing is, in the next video, I'm going to talk about 2 stocks that I think are very overlooked. They might be the baby thrown out with the bathwater, but they do have risks to consider. So if you haven't done so already, please hit that subscribe button right now and ring that notification bell so that you're notified when that video is available. Additionally, there's a huge risk for Alibaba and China in general, as companies are now starting to diversify their investments away from China. And I actually did a video talking about that risk, which you can get to right here.